Headphones just went out. I might have to swap these out. Oh, these might be dead too. Just getting my audio set up, sorry. My headphones just died. But it's good because I find that sometimes the stream doesn't immediately start, so people aren't on by the time it cuts off the beginning of some of my streams. So I am totally fine with this. Let me see. I'm trying to connect to my AirPods. Okay. It seems like these headphones still have some okay. I think everything's working now. I will try playing this video and test.
Free had an earthquake.
Oh, awesome. Okay, I hear it. Great. Well, everybody, welcome to the stream. Thank you so much. Yesterday we covered the difference between cryptography and cryptocurrency. And in that, I argued that cryptocurrency, although a lot of cryptographers think that cryptocurrency should be thought of as something unrelated to cryptography, they don't think that cryptocurrency should deserve the name crypto. I argue that it actually should. You should call cryptocurrency crypto. And cryptocurrency is, in fact, a subfield of cryptography. And so that's what I argued yesterday. Go back, check out that stream. I think it was really good. And I helped to build an intuition about the value that cryptocurrency adds to cryptographic systems. So that was part one of that discussion. Now, there is going to be a part two. But before that, I want to cover some important topics relating to financial markets because these concepts are broadly applicable to other fields. And so what I really want to get to, I really want to focus in on this concept of volatility in financial markets. And there's a lot of really interesting things to discuss in relation to volatility. Today, I want to react to a discussion between Mike Green and Chris Cole. So Mike Green, he formerly worked at Thiel Capital, and he now works, I think the company is called Simplified, and they have some really cool ETFs and stuff. And he's a finance guy, and basically his thesis is that index funds are completely distorting the market. So another time I want to dive deep into that thesis specifically because it's very interesting. I'll give you the short version. This is my take on it. This is not what he says, but basically the S&P 500 is a meme stock, and you really shouldn't just be only investing in index funds. It's a complicated dance that you have to do because the money to be made in the short term is going to be in index funds and the S&P 500. And that's why these investments have outperformed for so long. But at some point, it is highly likely that there's going to be a huge drawdown in the S&P 500 and just basically all the major indexes. And so ideally what you would do is you would have some kind of strategy where you both buy the indexes and ride them up, but you also hedge the downside. And that is most likely to do that in a way where you're not losing too much money in that part of when you're hedging your bet. It's really hard to actually implement hedges. It takes a lot of financial knowledge and creative thinking to actually implement a trading strategy like that. And a lot of people, when they do that, they lose money. And so that's where the nuances is. You want to have exposure to the stock market as it goes up. And this other guy who I really, really like is Chris Cole. Chris Cole, he focuses on his fund. It's a long volatility fund, essentially. And so what that means is basically he's betting that there's going to be major changes to the status quo. This is like a high level idea of it. So for example, if the S&P 500 continues going up, that is considered a short vol trade, because you're not expecting the S&P 500 to go way down and like crash. You're expecting it to continuously go up in the way that it normally has. And you're also not expecting it to go way up, like way more than you would expect. Like, for example, maybe you think you can get 15% in a year, or maybe a good year you get 30%, maybe a bad year you get minus 2% on the S&P 500 or something like that. You're not expecting it to go up by 300%. So that would also be, and that would be one type of volatility, is going up by a lot. And then another type of volatility would be going down by a lot, crashing. And so there's a lot of interesting implications for what would happen when the S&P 500 or major indexes crash. It would be catastrophic, but we won't go into that right now. But what I want to focus on is this idea of volatility. And so these guys are brilliant. I think Chris Cole, he's actually like a film student or something. He originally did film. And what I really like about him is that I know this might sound a little bit corny, but he kind of draws on ancient wisdom to some extent. Like he has these metaphors from these parables. Like he talks about like an Ouroboros, like a snake eating itself, and symbolism of this, a serpent and all these things. But he kind of relates these old ideas to new concepts, to build intuitions. And he has some really interesting things to say. So I've watched this video. I watched this video a long time ago. I guess this video is 3 years old, so it's not that old, but I don't really remember exactly what they talk about in this video, but any discussion between these two is really, really good. And so I'm going to be reacting to this. I think, unfortunately, I do think that this will cover some COVID related topics. And there was a lot of interesting things that went on in the markets, especially there's a thing called Volmageddon that happened. And this happened all around the time, like these, whatever is trendy to talk about at a given time. And so I apologize that they will probably be talking about that a bit in this, but we'll just kind of either just skip over that part, let's watch this to start learning about volatility from the masters of volatility. Okay, let's get started. Oh wait, hold on. I think this actually, I need to resize this because it's cutting out some of the screen. There we go. Okay, let's get started.
Behind me, and I'm speaking to one of the world's experts on things shaking, Chris Cole, my good friend, one of the OGs in the volatility space. Thank you for joining us, Chris.
Mike, it's a pleasure to be back here on Real Vision with you. I think it's been a couple of years. Last time we did this, I think it was with Harley at the EQD conference.
Yes, and so it has actually probably been, because that would have been the 2018 EQD conference. So it's been almost 3 years since you and I have had the chance to sit down on Real Vision and chat. Now, we've chatted offline an awful lot.
All the time, yeah.
Yeah, all the time. But ultimately, a lot has changed in the past year. And in particular, I would point to 2020 as being a watershed year in terms of identifying the value of the long volatility. I'm not going to use dogma is the word that's sitting on the edge of my tongue, but it's not the right word. The long volatility component in a portfolio, and how you have been an evangelist for that and really grown the space. 2020 really offered some exposure to that, and yet everything seems to have ended up totally okay. So I'd love your observations on kind of what happened in 2020 and how 2020 progressed, the unusual nature of it or the expected nature of it. What are your thoughts?
It's fascinating because we had one of the fastest increases in volatility in history. Really only rivaling the Great Depression and also the 1987 crash. And then one of the fastest declines in volatility ever recorded in history. And really the only thing that rivals that was 87. In the 1930s, you had very similar massive explosions in equity markets and declines in vol. But overall, vol remained quite elevated over the entire decade. Obviously, the driving factor is the Fed backstop on this dynamic.
So just for a bit of context, the VIX is an index that is used to model or to represent volatility. It itself is derived from certain financial data, and we could go into exactly how the VIX is constructed. Off the top of my head, I don't remember, but it is interesting. And I think one thing that he's going to talk about is how the VIX is actually something that people use in their financial models. So they pull this volatility information into their models, and in some ways this starts to become self-referential, because now the models have an implicit understanding of volatility, and so it's like the volatility feeds into the valuation. So then if the volatility changes, then the valuation can change, and this could actually cause an increase in volatility. And I guess we should probably I want to see if they will explain some of these concepts themselves, because they're going to do a much better job than I am of actually laying the groundwork for what does volatility mean, what is the VIX, what do we make of it. So let's just listen a little bit more, but I wanted to interject. And also, I didn't double check this. Actually I see up here 2021. So yeah, just like as context, this did air in 2021. They were talking about the previous year. I think it probably aired in 2021 or around 2021. The last year though was 2020. That's when COVID happened. That's when these events transpired, where volatility went up and volatility went down by a lot. And so in a sense, what's interesting is the level of volatility itself was at that time actually more volatile than normal. So there's a second derivative of the volatility. Volatility is getting more volatile, which is interesting. But let's continue listening to what they have to say.
And also the 1987 crash. And then one of the fastest declines in volatility ever recorded in history. And really the only thing that rivals that was 87. In the 1930s, you had very similar massive explosions in equity markets and declines in vol. But overall, vol remained quite elevated over the entire decade. Obviously, the driving factor is the Fed backstop on this dynamic. And I think at one point during March, I think I tweeted out, the Fed put may be dead. Boy, was I wrong about that? Was I wrong about that? I've always looked at volatility as the drivers of underlying vol as what I call this kind of unholy trinity between illiquidity and solvency, corporate solvency. And that drives the top of that triangle, which is vol. And what was fascinating is we began to see solvency problems, really even pre-COVID. Mm-hmm. That started in 2019. You and I have talked for so long about, you in particular, but I think both of us have talked about this, the influx of active to passive, and how that has removed this volatility buffer from the market. Mm-hmm. Active participants buy. And then
again, elaborate on this, but I'm just going to go through this point by point when I have something to add, just to make sure that we don't miss anything, because I think there's a lot loaded in those statements that he just gave. So what he was saying is that there's inflows from passive to active, and then what he's saying is then that the active participants buy. So active investing is a buffer for volatility. So what does this mean? So let's think about volatility as like the change in the value, the amount that the value changes both up and down. So if something's very stable, it's going to have typically cryptocurrencies are very volatile. They'll go up and down, and you can make a ton of money if you buy one early, and you could buy one at the top and lose all your money. It's crazy. That's very volatile. Now there's something called stable coins, which are very stable. They're not volatile. And so you buy it and it stays around $1 per coin or €1 per coin or whatever it's pegged to, and it's very stable. Stocks, like blue chip stocks, are often more stable than cryptocurrencies. So you can see how there's this spectrum of volatility. Now, so there's two things. There's one thing called active investing and passive investing. So active investing is where you, as the investor, go out and you try to decide what to buy and sell. So if you think a company is overvalued and you own some shares, you might sell those shares. Maybe you put a short position out on that overvalued stock. You would, there's a really good deal, like some very valuable company that's just the valuation super low, you would go and buy that. You would try and find all of the best companies to buy, and you're actively doing this. And there's other types of strategies, not just value strategies. There's other strategies, but the point is that you're using your brain and you're thinking, where should I invest? I'm going to intelligently allocate capital based on criteria that is going to lead to profitable trades. And ultimately that comes down to buying low and selling high. So that's active. That's like normal investing. If someone says I'm an investor, they're probably doing active investing. Now there's passive investing. And so this is index funds. This is buying the S&P 500. This is a thing that most people recommend to people getting into investing. They say, oh, the fees are so high in mutual funds, you shouldn't put your money there. You should put your money in index funds. Are actually taking up this passive strategy instead of an active strategy. And so now that really does work. It does work. And the reason why everyone is suggesting this is because if you look back historically, that has worked. But the problem is what happens when it's not just a few people doing this passive strategy, it's actually most people, and most money is being invested passively. If most money is being invested passively, that means that most people are buying stocks for, I'm just going to be honest, for stupid reasons. Like fundamentally, a stock should have, it should, the whether or not you buy it should be based off of the value of the stock and what it can provide for the money. There's some calculus there, and you can make like intelligent choices where you say, well, other people figured out what the value should be, so I'm generally bullish on the growth of the economy, so I'll just buy a bunch of everything and that should go up. And that's a good strategy if those other assumptions are correct. But if everybody else is doing this, then this starts to fall apart because nobody's actually putting in that buying power to correct any sort of things and actually get the prices in the right place. So what ends up happening is normally, and I'm not going to run through the full argument, I'm just going to try and talk about what he's talking about here. Normally, let's say a stock goes down. Let's say it's a good company. Let's say Google. Like Google, they have a really solid company, great engineers, lots of assets, all this stuff, it's super valuable. Let's say that people get very scared that Google is losing in AI because the latest Gemini release was just not as good. And let's say, maybe you should, think badly of Google, and maybe they're worth less as a result of their inability to execute in AI. It's a valid perspective. But what if the market over-exaggerated that? And it went way down. Like they just thought it's over. This is like 0% chance of them succeeding. Like this is done. Like their business is going to be over in a year. That's not true. So at some point, somebody should recognize that, and then they should start, bidding up, being willing to buy shares at a higher price as opposed to something super low. And what would happen is, as people come in as a reaction to this sell-off, they're going to be now putting buy pressure on the level, and maybe since people are actually noticing the value that Google has as a company, maybe it only drops 50%, or maybe it probably should only drop like 3% at most, based on AI. I don't know. The point is though, is it wouldn't go down by 90% because people would be willing to buy it at this higher price point, and it would be they would consider it to be a good deal because they have all this good things going for them, and maybe they will, eventually they very well could lead in AI. So that's just a simple example, but as you can see, there is, if people are actively investing, it makes things less volatile, and it makes markets discover the right prices a lot quicker. And so that's what he's saying. So let's continue listening to what they're talking about.
Active participants buy when stocks get too low, they sell when they get too high. You remove that buffer, and it all becomes about flows. And then the other factor is the reflexivity.
I just wanted to say one more thing before going into this next point. What happens is if everyone's doing passive, then everything becomes about momentum. And so if something goes up, then these passive strategies will typically index more on, they'll like weight it by market cap or something. So now, like, let's say that Nvidia is huge, and Nvidia is now worth a huge percent of the S&P. So now more people, when they're buying the S&P, are going to be buying more Nvidia. So they're never saying Nvidia is too expensive. They're never saying, never mind, I don't want it. There's no way you could sell that many GPUs or whatever. They're never thinking about that type of a thing. They're only thinking the price went up, therefore it's a bigger percentage, therefore I buy more. And so that just even puts, so then they'll sell Google and they'll put that money into Nvidia. They'll pump up Nvidia. Let's see what he has to say about reflexivity.
The Ouroboros from my 2017 paper, the reflexivity of vol driving vol lower and vol driving vol higher, as so many of these instruments rebalance reflexively in the direction. And we saw that all come together. The flows over fundamentals and the Ouroboros of risk all came together and into a massive liquidity crisis. And that was rapidly going to become a huge solvency crisis. And what occurred is they not only flooded the system with liquidity, and I think it's, they talk about CARES Act and what the Fed did with the idea of it supposed to benefit the individual person on the street. No, it was really benefiting massive hedge funds from
Hi, I'm Raoul Powell. I want to tell you, understand the global economy. It's a small fraction of what the week that we produce around us. I don't think you can.
What the Fed did with the idea of it supposed to benefit the individual person on the street. No, it was really benefiting massive hedge funds from and repo markets from forced deleveraging that would have caused this cascade of passive debt to the liquidity problem that we're now seeing in markets today.
So I'm not sure exactly what they did when they came in, and he's saying the Fed provided liquidity to the markets. I'm not sure historically what that indicated. So I want to just continue listening to what he's saying before chiming in with any more commentary, just to see if we can get a fuller picture of what happened back in 2020.
And it really is a culmination of everything you and I have been talking about the last 5 years, but has evolved into a different and unique phase.
Let's build on that for a second. So there's a couple of things that you talked about there that I'd like to expand on, right? So one is this idea more associated with significant economic uncertainty, right? So, you and I have discussed this repeatedly, the dynamics that the VIX has basically a bimodal distribution, right? During periods of recession, where you have the dynamic of broader asset volatility, income uncertainty, effectively the flow of income associated with assets, creates conditions under which there's higher risk of credit default, et cetera, that terminates your option as an equity holder, right? And so you experience higher levels of volatility under those conditions. 26th, we're seeing a new low effectively in the past year coming off of the events of 2020, where the VIX is now back into the 18 range, right? But we kind of forget that VIX was 9 in 2017, right? So half the levels that we are today. Why do you think that, one, what do you think drove the rapid retreat in volatility? And two, what do you think has driven the dynamics of keeping that volatility relatively elevated? Is there anything unusual about this period from your perspective that has prevented volatility, or do you think it's likely that ultimately the VIX is going back to 9? Are we going to move to that level of quote unquote safety?
I don't think we're going to see 9. If you go back to 2017, when I think you and I actually spoke at the EQD conference, and we had a very heated debate with the founder of XIV, at that point in time. In the next 2 years, it'll hit all-time highs. And we ended up both of those. At the end of that paper, both of those predictions came true.
Yeah.
Nice.
So I think that's driven by that flow reflexivity. So it really starts out with the Fed. They come in and they flooded the system with liquidity to solve some of the discrepancies. Certainly, you've talked a lot about this, how you have some of these Vanguard funds, some of the most liquid bond funds in the world, BND trading at 6% discounts to the NAV. right? And so you flood the system with liquidity to deal with the liquidity problem, with the repo problem.
Okay, so they're saying, okay, this is finally getting into how they solved the liquidity problem. So I'm not aware of this. I'm kind of coming to this from an ignorant perspective. So let me see. So liquidity, the Fed solved the liquidity problem. The Vanguard Total Market Bond ETF, a 70 billion debt discount premium to NAV. I'm not sure what NAV stands for. Let me take off this closed caption so we can see this. And so then, so you see, I mean, it seems like this is the discount premium up above, and you see a spike in the discount. And usually there's a bit of a premium, but at one point these bonds were highly discounted. And now you see the U.S. Treasury bond 10-year bid-ask spread. So this means that basically around this time of this spike, there's a huge spread on how much people wanted to sell it for versus how much people wanted to buy it for. Okay, this isn't really saying what the Fed did, so maybe let's just keep watching and see if we can get any insight into this.
Problem with these massive leverage basis trades and to even out that liquidity issue. Stopping this kind of force.
Sorry, I want to add closed captions so that we can easily see this. I'm going to go back a little bit.
It'll hit all-time highs. And we ended up both of those, at the end of that paper, both of those predictions came true.
Yeah.
So I think that's driven by that flow reflexivity. So it really starts out with the Fed. You know, they come in and they flooded the system with liquidity to solve some of the discrepancies. I mean, you know, certainly, I mean, you've talked a lot about this, how you have some of these Vanguard funds, some of the most liquid bond funds in the world, you know, BND.
So I think what he's saying is that the Fed was basically means that they were injecting cash into the system. And by doing this, I mean, basically, they were bailing out people who were holding bad debt, or who wouldn't be able, or they were like maybe suppressing interest rates so that people would be able to make their debt payments. And in a sense, they kind of bailed people out from.
Right. And so you flood the system with liquidity to deal with the liquidity problem, with the repo problem, with these massive leverage basis trades, and to even out that liquidity issue. Stopping this kind of forced deleveraging. And I think one of the things that was really scary during that point in time is we were seeing deleveraging in both treasuries and stocks at the same time, destroying risk parity. People have forgotten about that and how dangerous that was. Once again, something we've talked about for a while. You know, that March period where you're seeing forced selling in everything, including high grade U.S. treasuries, destroying kind of the 60-40 and risk parity portfolios, represented really an existential threat to the entire system. So they flooded the system with liquidity. That dealt with one aspect of the unholy trinity of all. The second thing they did, which was really, I think, incredible. And
so one of the things that he's alluding to is just this idea that everything can collapse. And like it basically, if everything kind of built up based on these momentum-based trades, you know, when there is a reversal, if that reversal is powerful enough, it can actually collapse it can like now that momentum that has been going up and pushing everything up because everyone's just stupidly following this passive strategy. Now that momentum will be going down, and so now, you know, something goes down more, you sell it more, you know, it's out of the index now you sell all of it, now it just pushes that down to zero, right? And there's nobody coming in, or if there is, they have very little money to put in, it won't make a difference in the price. There's nobody to then, you know, push up those asset prices when they're plummeting. And it's just basically like a death spiral. And the other thing, there's probably some more subtleties to what he was saying about risk parity, but basically risk parity is a leverage strategy that is predicated on some certain assumptions. And I need to think through all of these assumptions exactly, but basically what it is you lever up your exposure to treasuries so that it has the same level of risk as stocks. But since they are like uncorrelated, there's some sense, I think, in which that actually gives you better returns. But if both treasuries and stocks are crashing at the same time, I think what the implication of what he's saying is that really wipes out anyone with any sort of risk parity type strategy. And essentially, I mean, like, let's just, without going into the technical details of the financial engineering behind all of this, like, just on an intuitive level, just think about if you are taking debt to buy any sort of asset, when things go down, you get, like, when it goes up, you get extra, benefit. And when it goes down, you really lose, you get wiped out. So, I mean, risk parity is a leveraged strategy. So when things crash, usually the reason why people like it, I think, is because even if like the stock market crashes, then like there's reasons why you wouldn't expect the bond market to crash necessarily at the same time, or vice versa. And so these things kind of counterbalance each other, and there's just this lack of correlation where usually you're fine. Whereas, what he's saying is that treasuries were crashing, and like basically people were not willing to buy it for what people wanted to sell. There was this large spread, and ultimately like there was a discount on them, and so the Fed had to step in so that not everything crashes. And like the implication of if the market crashes under conditions like this is like everyone's pensions, everyone's retirement savings, a bunch of businesses will go out of business. It'll be a massive depression, and like everyone, basically a lot of value that has been nominal value in the system will be wiped out. So let me continue.
And arguably, at least in the words of Jeff Gundlach, against their charter and potentially illegal, is the fact that they, in essence, backstopped the corporate bond market,
right?
Using a conduit with the Treasury Department, and in particular, looking at that lowest grade of corporate debt. That lowest grade of investment grade debt that was about to be downgraded. So it was intentionally supporting that. And that really tried to take off the solvency problem. So these two legs that focus on volatility, they dealt with these two corners of the unholy trinity. And then that allowed for the flows to start coming back in the market. And we started driving the reflexivity in the other direction. It's interesting in March because at that point in time, you talk about XIV, there was another product, TVIX, which they discontinued.
Mm-hmm.
Why did they discontinue this? If you look at how big TVIX got, we were another 10 points move up in the VIX, which would have required a rebalancing that could have shot volatility easily into the hundreds, implied volatility easily into the hundreds, because like the inverse of XIV, you had a product that suddenly would have had to buy multiples of the volatility available in the market at the worst point of market liquidity. So why would they discontinue that product, which was a very profitable product for them, a couple of months after March? Well, I can speculate, don't know, but I can speculate that the reason they did is because they saw the monster they created and they understood how that could have potentially even destabilized things even more. The same opposite direction of XIV. So you get all these flows coming back. You get everyone starting, credit funds. You get flows coming back. You whet the appetites, the Wall Street bets crowd, and the entire passive universe to flow all this money back into markets. And you begin the reflexivity spiral back in the other direction. As you've always articulated, there's when you remove the active buffer, there is a gap down and there's a gap up.
Right.
So if you have no additional seller or buyer on the other end of it, the volatility can move in both directions. And as a result of that, we have seen something we've talked about offline, the most the serial correlation or the negative autocorrelation or the tendency for mean reversion in the market reached all-time highs in the history of the equity market. The daily mean reversion reached all-time highs in the history of the equity market.
I'm sorry, take a step back and explain what that means. Daily mean reversion.
So the daily mean reversion is how is the return today correlated with the return yesterday?
Okay.
And what's interesting is when we were on the gold standard, markets tended to be autocorrelated. And what that means is that, if today was up, tomorrow is likely to be up, and the day after is likely to be up. But in this age of proactive central banking, what we've seen, and part of it too is the natural framework of coming down. So you could buffer a decline in markets. And we moved from a period of secular highs in autocorrelation, or secular highs in trend. I should say that's an easier term for people to understand. Right. Is that pre-1970s, during the gold standard, markets tended to trend. Equity markets tended to trend. And as we've moved forward to this new age of central banking, it's the opposite has occurred, where now markets tend to mean revert. And the mean reversion that we have seen over the last year is unprecedented in the history of U.S. equity markets. There is no precedent for it. And one aspect of that could be deemed, the driver of that is naturally the monetary stimulus and fiscal stimulus. But the amplifier of that, well, this is a little bit of a chicken and egg proposition. It's a little bit of a chicken and egg proposition.
I know where you're going here, but I want you to articulate it. So,
but the amplifier of that, the thing that puts that on the nitroglycerin that causes the explosion, is the flows. The flows over fundamentals, the dominance of passive, the dominance of quantitative strategies that use whatever they are, that use correlation, volatility, as a driver for the allocation of risk. And so that combination, combined with the backstop of liquidity, combined with the backstop of solvency, is what has driven this massive reflation and this massive collapse in volatility. I think that kind of explains what we've seen in the rearview mirror. But it also has left some tremendous dislocations in markets under the surface that are absolutely fascinating to take a look at. You and I met back in 2012 when both of us agreed on this concept. This concept I presented at Grant's conference on the 2012 paper. The idea of a bull market in fear, a high VIX. That's not or high realized volatility. What it means is that the market's expectation of volatility remains quite high. And that expectation of volatility can be expressed by the term structure of forward variance, or another way of looking at that is the VIX futures prices.
Right. VIX futures curve is
VIX futures
curve is the way I would describe it, but yes.
Yeah, as a linear extrapolation of forward variance. Another way of looking at that, so right now we have a very steep VIX futures curve, despite the fact that volatility has come down. It's steeper than historical norms. One of the things that you've brought up is that there's incredibly high implied correlations. The market's expectation of asset price correlation is actually much higher where correlations are kind of realizing at this juncture. And another aspect of that is very high elevated skew. In essence, how much people are willing to pay for protection, out of the money protection. I don't think we're nearly as high as where we were in 2012, but so I'm not saying that it's as extreme as we were there. I wouldn't be pounding the drum saying let's short volatility the way that there was kind of that kind of obvious idea in 2012. But it does create some dislocations, and it's particularly interesting to observe these relationships as they've dislocated from things like credit spreads, particularly as rates are rising, and what that means on a fundamental.
Okay, there's a lot that he covered there. There's a lot of interesting points. So I think what he's getting at is just going back here for a sec to see all the different charts that were put up. Okay, so there's kind of one Yeah, let me just basically talk about this. It seems like what he's saying is that there is an expectation that volatility will increase. So like the futures market for the VIX would not just be measuring the current volatility, but would also be predicting to some extent what the future volatility would be. So it seems like what he's saying is that there is an expectation to like if we're kind of talking earlier about hedging your bet. Like if you're invested in the S&P, you might want to hedge the S&P if there's any huge movements. And so it seems like what he's saying is now at this point there is more demand for protection against huge movements than there have been. And that is reflective in this idea that we might expect that volatility will increase in the future. And I think it might have been, I mean, there's been times in history, I think maybe 2012, this is what he was talking about there was some situation in 2012 that it's not as bad as at that point. But there have been times in history where people have been way more concerned with insurance for their portfolio rather than they basically have been overwhelmingly scared and willing to pay a lot to hedge their portfolio and make sure that they're protected against large swings in the market. And basically, like you can think of this as portfolio insurance, they were willing to pay very large premiums just for protection of their holdings. And there have been times where you had to pay so much for that it hasn't even been worth it to do. And at that point, you might want to actually short volatility because buying volatility is actually, in this case, he's saying there could be times where you short volatility. And he's not saying to do that now. He's saying this is not one of those times. Okay, now I kind of started talking as he was getting into this. So let's just go here and continue listening.
That there was kind of that kind of obvious idea in 2012, but it does create some dislocations, and it's particularly interesting to observe these relationships as they've dislocated from things like credit spreads, particularly as rates are rising, and what that means on a fundamental and macro basis looking forward.
Let's dial it back for a second to help explain a few of the terms that we've used here, right? So, and some of the drivers of this type of dynamic. So first, when we talk about implied correlation, or we talk about that being high relative to history, right? So the way the VIX is calculated is that it represents the pricing of the strip of options available on the S&P 500 with 30-day maturity. The S&P itself is composed of individual securities, right? So Apple, Microsoft, Tesla, et cetera. And each of those has options against it as well. And so behind the scenes, there are players in what's referred to as the dispersion trading that are actively involved in pricing both the individual security options and the index option. The price of implied correlation is the integration of those two components. And the feature of skew that you refer to, the increased price for out of the money puts, for example, is largely a function of the fact that single stocks don't have a correlation component to them, right? So the pricing of Microsoft options doesn't reflect increased risk that Microsoft is going to behave like Tesla in a big sell-off, right? So the option itself can't incorporate that price because it's irrelevant to somebody who's playing exclusively in Microsoft options. But the index has to reflect that higher implied correlation in the event of a crash where both Microsoft and Tesla are falling in tandem. Feel right? So yeah. What's happening in that measure is by and large, it's a function of people being aware that in the event of a market crash, the implied volatility for the index is going to rise much more than the implied volatility for the single stock. And so that has to be priced into what's referred to as this implied correlation. And it shows up in a measure of skew, which is the excess premium that you're paying in terms of implied volatility for the out of the money put on the S&P 500 versus the at the money put in the S&P 500, or the equivalent call dynamic.
Someone did such a great job of it now, so apologies to whoever that is, but trading, imagine you have an index of two stocks. And so you sell a straddle on that index, and you buy straddles on the underlying options of the underlying stocks. One stock goes up, one stock goes down, one stock goes up. You make money on the individual stock option long vol plays, but the index doesn't do anything. The index stays static, and you make money on the implied vol short on the index. This is what is a dispersion trade. Except people do it with much more complex models across an entire index.
Right.
So,
it's incredibly difficult. It is adult swim in a lot of ways, and it's actually been surprisingly unrewarding in a lot of ways for the past almost 2 decades. Right. I mean, the heyday of dispersion trading was the 1990s. You and I have both talked about the dynamics of concentrated volatility in single stocks, where 5 stocks in the S&P 500 accounted for 60% of the implied volatility, sort of thing, in 1999. Today, the volatility levels are much more broadly distributed. There's less of that dynamic. But the other thing that's happening that I think that's really interesting about this is the question.
That was interesting. I don't want to go too deep on that. It would be really cool to see some sort of visualization. I don't have one prepared here, so I think we should just move on and just get to more of the meat of their conversation.
Of should Skew be properly priced in, right? Because as more and more transactions happen at the index level, you run greater risks effectively of everybody deciding to sell all stocks at exactly the same time. Effectively, the realized Skew levels rise. And you and I were discussing this before we got online. Some of my work suggests that there's been a dramatic increase in the realized Skew dynamics associated with markets over the past 40, 50 years, right? That those have changed quite dramatically. How do you think about incorporating that into some of the extreme dynamics that could occur in markets, and kind of the opposite bias, right? Which is the offset to that negative Skew is increasingly positive drift, where the same dynamics of money flowing into passive vehicles that hold less cash and have a positive momentum loading is leading to higher valuations, and therefore leading to a bias towards appreciation in the markets. How do you think about that sort of component in your analysis?
Yeah, it's an interesting dynamic because it becomes a kind of tail wagging the dog framework. Because in effect, everyone rebalances and everything flows into indices or ETFs. And to explain, and I think you have a wonderful chart that kind of shows this, but this idea that what you have is a framework where the market, everyone is moving into the passive vehicles. And instead of the individual stocks determining where the index goes, it starts from an index top-down level. And then I think what you're saying in that sense is that even though traditionally people have looked at this risk premia as something that is something you want to harvest all the time, it's possible that we're in a new regime where as the more passive dominates, the more acceleration or potential for Skew realization can occur on either tail of the return distribution. And this is certainly what we've seen certainly what we saw in March and April, where, you had March,
So I'm not fully understanding this point relating to Skew. I think what Skew is essentially the divergence of the performance of the component stocks of an index compared to the index itself. And so, but I think what he's saying basically here is that increasingly, as the index is the determinant for the price of the underlying stocks, like basically the amount to which someone invests in an index rather than the amount to which someone comes in and actually values the company, you're going to have an increasing Skew. And I believe that implies also more volatility. Like, just think about it this way. Imagine that you have a startup company and you go to a bunch of investors and you say, can I have some money? They say, no, I don't want to invest. And you go out and talk to all these people, and no matter what, because you're on that list, wants to go and invest in you. Now, there is going to be basically the dominant force in the value of your equity is going to be the list and not your actual underlying at least value prop as a company. And I'm not really sure how to draw that skew analogy here, but that is kind of a similar type of situation. You can see how these are fundamentally different things and can lead to some weird behaviors if a lot of people are just investing based off of lists. But let's just keep listening to see how they develop these ideas.
Scale of the return distribution. And this is certainly what we've seen certainly what we saw in March and April, where, you had March, huge down period, and you had April being a huge up period. And the fact that passive flows or the flows over fundamental framework is in effect amplifying skew utilization on an index level, driving the underlying stock composition.
Yeah, I mean, our mutual friend Corey Hofstein has done some interesting stuff on some of these dynamics, right? And so, if I think about how I would describe February, March, it was not the passive players panicking; it was the active players who suddenly were panicking and chose to hedge either through index instruments or through liquidating single stock. And so, if you almost think about it from a probability of certain action, right? If you're an active manager, there's two ways you can lower your exposure. You can sell the stocks that you quote unquote have picked and loved, or you can sell S&P or Russell futures, right? Or Qs, right? And one is extremely liquid and extremely easy, but contributes to exactly the dynamics that we're referring to. And then the second component, if they sell the individual securities, is going to cause those individual securities to underperform, right? And as those securities transition out of the active manager portfolios into the money that is flowing naturally into passive type portfolios, you create these weird dynamics where once you're out, it's almost impossible to get back in, right? There's a very famous line very famous in our extremely weird world in the book Reminiscences of a Stock Operator, right? Where one of the older players is saying, but I don't want to lose my position, right? He refuses to sell because he doesn't want to lose his position. I would argue what happened in April or March was the dynamics of people having lost their position, right? And trying to go back in to buy stuff as it became clear that the Fed was coming in and that, the economy was not going to be allowed to collapse in a, liquidate stocks, liquidate labor, et cetera, type framework. As they tried to buy back in, the stocks that they had sold were suddenly much less elastic, had experienced higher inelasticity in the rebound, right? Now,
I'm not sure I'm following this thing about losing the position, but essentially what he's saying is basically if you're underwater as an active manager, you're in a bad position, you can basically you can kind of buy the index or make a trade surrounding the index, or you can sell your individual holdings. And if you sell your holdings, you're basically pushing those prices down even more, and you're contributing to the problem. I'm not sure what he means though. Why can't you buy why can't you buy them once they're down and everything's going up? I mean, in a sense, I think maybe because there's just going to be less buyers at that point, and there's just more money flowing into the passive investments. But I think the overall big picture of what he's trying to say is essentially that it is more profitable to buy into these momentum-based trades into these indexes rather than trying to do something with individual stocks. And as people get squeezed and as people start losing out because they're not in the indexes, they end up just exiting their positions and pushing those positions even lower. And there's not and kind of at some point there's just less incremental buyers for these active trades. And so it's just going to basically these companies that are not in the indexes and that are not at the top of the market and top of mind for the passive investors, these companies are basically just languishing, and there's just not that much demand for them, and it's just much harder. Like they're just like very illiquid, and it's just much harder to actually make a trade on these stocks. But anyway, let's continue seeing what he says.
All played through pretty crazily, but equities were almost a sideshow in this vol collapse relative to what we saw on the credit side. And you alluded to this earlier, but we saw high yield and IG collapse much more quickly than we saw on the equity side. What is that? And we obviously know that the Fed played a direct role in that by stepping forward and, as you pointed out, supporting it. But what are the implications of that sort of dynamic? How does that create opportunity, or does that push us further towards the ultimate Minsky moment in your mind?
I think it does push us further towards the ultimate Minsky moment. And I think you're very kind to people, to active, because I think, particularly the quantitative space, I think it's not like Thiel, of course, you had a monetary backstop. As much as equity vol has come down, we've actually seen high yield credit spreads and investment grade credit spreads come down even faster. And I have a wonderful chart about this that shows corporate debt to GDP is now at all-time highs in history. And if you look at that, that tends to occur before massive vol spikes. When you have huge corporate debt explosions as a percentage of GDP, usually a big vol spike follows. Well, and this was already at all-time highs pre-COVID. So this is not a COVID scenario. This is not a COVID phenomenon. Daniel DiMartino Booth talks about how the Fed probably already had their game plan to deal with credit stress pre-COVID, been formulated prior to that. But despite the fact that corporate debt to GDP and that corporate debt is at all-time highs, corporate credit spreads and OAS spreads are at all-time lows.
Yeah.
And even though this comes to a second chart, even though implied volatility has dropped, those credit spreads have dropped even faster, to the point now that the implied volatility, particularly of like a 25 delta put, and you can see this for at the money, the ratio of implied volatility of the S&P to credit spreads, corporate credit spreads, is at all-time highs. Truly an anomaly. So one way to read this is that people may be, in essence, there might be a backstop expectation of, there might be an expectation of greater equity vol and potential sell-offs, but the belief that the Fed has the credit market in check. Well, a second thing that we're also seeing is that the implied volatility of US Treasury bonds as a ratio to those same credit spreads, it's another chart here, is also at all-time highs. And this leads into an interesting conundrum, because equity vol and Treasury vol tend to be correlated to credit spreads.
Right.
Generally speaking, when you see solvency problems, that's what leads to rising implied volatility. In essence, in many ways, you could look at credit spreads rising and corporate solvency problems as the precursor to higher implied volatility in equity markets.
So just to again dial it back and help to explain to people how that occurs, right? When you introduce credit into a corporate structure, you are introducing a vehicle that has change of control features, right? And so an equity can ultimately be thought of as the claim on the excess cash flows that exist over and above debt service for corporate profitability out into the future. But if at any point you are incapable of servicing that debt, then the debt holders theoretically have the opportunity to cut short your option to receive those excess cash flows, right? And so in that environment.
Yeah, and so I think one of the points that he's kind of making about liquidity and the Fed having injected liquidity is basically that there's just kind of like not enough cash around. And so people didn't have enough cash. And so what would happen is, since if you, like, let's say you have a great long-term plan and you have some debt, so you've purchased some factories and you're going to make these things and you're selling them and you know it's going to be great. But unfortunately, you have debt payments that you have to make. and but you can't. You don't have cash. So how do you? I mean, so what would you do? You would try and go get some cash to make these payments. But let's just, for the sake of argument, say that's a normal situation. Let's say markets are functioning really well. If you have long-term, if you have long-term prospects under normal conditions, you can just say, hey, look, I have this amazing factory, I'm making these amazing things, look at this, I just need some capital, then I'll make these debt payments as I finance these factories. You would be able to go get this money. But unfortunately, if let's just say that there is a liquidity crisis, as they call it, and now nobody has cash, or very few people have cash, there's just not that much cash to go around, but there's a lot of debt payments, and their debt payments, and they just don't have enough cash on hand. Even if the business is solid, maybe they have real estate assets and all these things that are worth billions or whatever, but they just don't have enough cash on hand. Either way, you can't make your debt payments. And so this is a huge problem. This causes insolvency. And then what happens is the debt is priced over any claims that an equity holder has, because basically the equity holder bought equity into an indebted organization that wasn't able to follow onto its commitment. So there's a variety of ways of handling this. Maybe they have to sell all their factories or something. Now someone has to then still come with cash and pay for those factories, and if nobody has cash, that's a problem. Or maybe they can cut out some kind of deal that would then hurt the creditors, because the creditors would be getting less than they had bought. So there's a lot of downstream implications on credit markets if people are defaulting, and this is again a solvency issue. And like another option is like declaring bankruptcy and liquidating the assets, and basically this completely destroys all the value that the equity holders have. So like you might think, well then this just sounds bad. Why would anybody ever take on debt? Well, debt also can accelerate your gains. Like imagine that you could build one factory per year. So, and you need a bunch of factories. So over the course of years, you make one factory per year, and you're able to ramp up your production because you just have only so much cash. And so you can't, finance building more factories. So you have to slowly make more and more and more. That's fine. That could be a good way to grow a business. Maybe it takes more than 1 year. This is just example dummy numbers that I'm working with here. But now imagine that you use debt, you take loans, and now you're able to make multiple factories in 1 year because you have the capital to do so. Now you start producing your product a lot sooner, and you're able to do this in parallel. And so you let's say you made 5 factories instead of 1, you would make 5 times the money, more or less, instead of 1 times the money. So another example is people take mortgages for their homes. You put down a 20% down payment. So that's 5x leverage. So if your home costs $1 million, you put in $200,000. The other $800,000 is provided by a loan, and you have to pay this mortgage payment to the bank. And so if let's say that the home increases by 10% of value, so it goes from $1 million to $1.1 million. So it goes up by $100,000 total. Now you own this home. So you have earned $100,000 by holding this debt. And you only had to put in $200,000. So now your $200,000 just went up to $300,000 because you gained $100,000. And in doing this, you gained a 50% increase in your money. But the home only went up by 10%. So 50 is 5 times 10. So you just made way more money. So when people, invest, there's all these jokes about, crypto people having insane leverage, 100x, just max out the leverage, just whatever, right? The idea behind that is that can go up like crazy. You could become extraordinarily rich by having some volatile asset levered, and you can just make a ton of money on the upside. Now, there's another issue, though. It's like what we were talking about earlier, is there's a downside to this debt. And similarly, it can wipe you out to zero. And even sometimes, there's cases in which you go below zero and you have to contend with that. That can also be a nasty situation. But typically, you can just think of this as wiping you out. And it's like there's this kind of a saying where it's like you go up by 10%, you can go down by 10%, it's fine. You go up by 50%, you go down by 50%, it's totally fine. You can go up by 100%, like from like $1 million portfolio to a $200 million portfolio. You go up by 100%, you go down by 100%, and then you're done. You can't make any percent from zero to get back to anything. It's zero is zero. Zero is a special number. And so there's this downside insolvency risk. I mean, and we kind of have been talking about how this is like a cascading effect systemically through the mechanisms that they've been talking about. But that is why this is why like a liquidity crisis can lead to extreme volatility. And let's just hear more what they're saying here.
Debt just over and above thought of as features, the corporate structure.
And then I guess kind of what he's saying about the control structure, I just wanted to inject this, is that you don't really have a choice. You have to make this debt payment. And at the point at which you're going insolvent, it's not just, you don't get to just decide what's in the best interest of the company and just keep operating, but don't pay the debt. You can't do that. So it takes over. And like, for example, there's points at which if you can't pay your mortgage, the bank will foreclose on your house. It's not your choice. It's in the contract. They get to do that at a given point when you're not able to pay. And similarly, if you take leverage on stocks or crypto or other investments, at some point you are not deciding when to sell. If it goes down by a certain amount, you will be liquidated, meaning the lender will take control of the underlying assets and sell them on your behalf, and you have nothing you can say about it. So it's not like you can say like factories are good, long-term prospects are good, I'm never selling, I'm never stopping, but it's not up to you. Once you take on debt, now this alters the control structure of the company. Debt is now above all else, but it's also powerful.
You are introducing a vehicle that has change of control features, right? And so an equity can ultimately be thought of as the claim on the excess cash flows that exist over and above debt service for corporate profitability out into the future. But if at any point you are incapable of servicing that debt, then the debt holders theoretically have the opportunity to cut short your option to receive those excess cash flows, right? And so in that environment where I'm uncertain as to whether I'm going to be able to lay claim to that 30-year future or that 50-year or infinite duration, however you want to think about it, stream of excess cash flows, that can be cut short by a default event instantaneously. And so we see volatility for the equity space explode alongside the credit space, right? With the credit spreads rising because of that potential change of control feature. What the Fed effectively did in March was they stepped in and said, we will not allow a default event to occur. If you're having trouble servicing debt, you hit us with a PPP request and we will give you guaranteed debt you absolutely can access at the corporate level, effectively the equivalent of the Fed's discount window, right? And even better than that, we're going to make that Fed discount window forgivable, right? If you can demonstrate to us that the liquidity challenges were a function of a global pandemic as compared to something unique to your business, and that you spent it on continuing to employ people to smooth out the flow of capital, the flow of income in the U.S. economy without having to turn to massive unemployment supports, et cetera, we're going to potentially forgive that and give you a massive.
So, okay, this is great because he gave a little bit more specifics. So there was this thing called PPP loans, Paycheck Protection Project. I don't know what it was called, but this was a bunch of loans that were given out to businesses, and the goal was to maintain employment during the hard times of COVID. And I'm sure there's other programs that they're talking about here, like operation in the repo markets and stuff like that, which I'm not very savvy about. But there's other things that they were doing, but this is one of the specific things that he mentions that injects liquidity into the system. And so essentially, companies were going to go insolvent. They were going to default. They were going to have bad debt. And what the government did is not only did they just provide more favorable loans that people wouldn't otherwise be able to get, which is one way that they can inject liquidity, but they also basically gave people free money. These PPP loans were not kind of forgivable, kind of not. I mean, in effect, it seems like all of them or most of them were actually forgiven. So if a business got a PPP loan, as one example of the type of thing that they did, this PPP loan was basically free cash. And so the idea was, we know that you're going out of business potentially, you're going to default, you're going to lay people off, you're going to make cuts, you're going to downsize, you're going to liquidate your assets. We know all that's going to happen. We don't want that to happen. So here's some free money so you can pay your shit. And so this is a very interesting thing. I mean, especially let's just think about this time and during COVID, a lot of businesses shut down. They couldn't operate. Like these in-person businesses, they couldn't operate. A lot of knowledge work-based businesses had to reorganize what they were doing. And so like they had to switch from in-office to remote. And that was just a very inefficient process. And they had to figure out how to do all this. So they weren't working. So all these people, basically all these people were doing a bunch of either stopped working or lost business or had to spend time on non-productive things like reorganizing their workforce rather than doing productive things like making productive work. So it makes sense that there would be a lot of issue with creating less output at that time. And it makes sense that basically companies could get in a bind because they're not doing profitable activities. So you can't really expect to have a great financial situation necessarily. So the issue though is that this was not just a normal circumstance. The issue is that we had structural problems in our stock market where if this were to happen, not just the stock market, financial markets more broadly, is that if it wouldn't have just been a small recession or something where okay, some businesses went out of business, there's some unemployment increase, it makes sense, there was a pandemic, all of that. That was not the scenario at hand. What would have happened is there would have been a cascading effect where everything, like there's been all this momentum going up and all this correlation going up and all of that would reverse and it would start going down. It would be a cascading spiral going down if everyone's selling. And that's because everyone is employing, in part because everyone is employing these passive strategies. And so as things go down, they're weighted less in the index and they buy less of it. And they just keep adjusting, and everything just keeps going down. As a result, it goes down even more. And also, I think that there's some extent, which they haven't really covered here, but there's this idea of, people are now taking positions on volatility itself. And so then in order to kind of service these trades, you kind of have to on potentially increasing volatility because you're making these volatility-based trades with the VIX. I'm not exactly sure on those mechanisms, but there's something to that as well. Let's keep watching.
Massive equity injection effectively, right? And so there's been no question that has been a primary characteristic here, right? That abrogation of the risk of change of control kind of sits at the center of this very rapid decline in credit. The other side of that, you mentioned the steepness of the VIX curve. We're actually starting to see extraordinary steepness in the credit curve as well as the rate curve, right? So if I think about the dynamics of what the market is implying for today's, the current level of investment grade debt, is somewhere in the neighborhood of, a US 5-year rate at, I don't know off the top of my head, but let's say it's 30 basis points and a cost of debt, right? But if I go out 5 years forward and I look what the market is implying there, all of a sudden we're talking about the cost of that debt rising quite significantly, right? Because you're looking at a steep forward curve in rates, you're looking at a steep forward curve in credit. That's creating conditions under which there is a refinancing risk, there's a cash flow servicing risk, unless the economy continues to recover.
That's such a fantastic segue into this kind of next point, and a beautiful segue into this next point. Because on one scenario, let's imagine that they're able to engineer inflation.
Yep.
Well, I go take a step back. What they did is to solve a liquidity problem, they've created an even bigger corporate solvency problem. The corporate solvency problem was at all-time highs prior to COVID. So it's not like COVID, it's not like a one-time thing with COVID. This was a problem pre-COVID. It's gotten even bigger and more massive post-COVID. Well, we're still going through COVID. Well, so let's imagine I'm agnostic to whether or not rates stay low or whether they go high. I don't know. Let's just say I don't know. I don't have an opinion. But let's say they succeed in their ability to engineer inflation. And as a result of that, we get a renormalization of rates. Rates go back, not massively. We're not talking hyperinflation type of stuff or 1970s stuff. They go back to where they were at their corporate rates go back to where they were throughout most of existence, and that's about kind of where they were in the mid to late 90s. Under that scenario, just based on a simple back of the envelope calculation, the rising interest payments will force net profits to drop by 1/3. Corporate profits will drop 1/3 if rates go back and corporate borrowing rates go back to where they were in the late 2000s. That's not including the number of kind of zombie. Let's imagine rates go back.
So I'm not fully understanding why a liquidity crisis creates a corporate insolvency crisis exactly, but I do understand some components of what he's saying. So first of all, like, let's just also, I wanted to say this earlier, like all this stuff, giving people free money, basically giving people more favorable loans. This is essentially an inflationary activity. Especially just think about creating money and giving it to people. That creates more supply of dollars, literally, and it's supply and demand. So as the supply of one thing goes up, the price relative traded with the other thing is going to go down. So that creates inflation, creating more money. So this is already an inflationary thing. But I think what he's saying is, like, let's not get caught up on the specifics of whether the Fed will be able to pull off where basically, like there's this example that Anatoly, the founder of Solana, gives, and I really like this point when he talks about housing. And I think he talks about like housing policy in California, things like this, where he says if there's 100 homes and 101 families, there's no amount of financial like engineering that you can do to house every person. Like, you can't tax people more. You can't have any policy that gives a house to each family. If there's only 100 houses and 101 families, there's just no way that not everybody's going to have a house. At some point, you need to build more houses. And I think this is a really good analogy and a really good point. And like applying that to this situation of like what happened back in COVID is that I think like basically we stopped producing things. And so when we stopped producing things, we were less productive, we did less, we made less progress on all of our goals. So it makes sense that we would have less stuff. The supply of general goods in the economy would be lower than it otherwise would be, and therefore there's a relative oversupply of capital, which was also injected into the system so that we didn't have a mass crisis. So there's like simultaneously more capital and less goods. This is not just one-sided reason to have inflation. So there's a lot of reasons why we have inflation, and I think that this was even, I personally think that we don't even know the extent to which that did us harm. This was a very harmful event that happened to our economy. And I think there's probably a lot of reasons why that pain has been covered up. And I think at some point we're going to have to face the fact that we just really did something that was economically destructive. And we haven't really come to terms with that necessarily. But going back on the point that he is making is he's basically saying like, okay, like let's just assume and they are able to basically like do everything right with inflation and get everything perfect. In that scenario, we would expect rates to normalize. So rates have been historically much higher than they have in recent decades, especially, how far back does this low interest rate era go? I think maybe late 90s, early 2000s, interest rates were low. Then 2008, interest rates were very low. So like Alan Greenspan famously has lowered interest rates and kind of caused there was a dot-com boom, and then there was a housing boom in 2007, 2008. So leading up to that, rates were low. There was a lot of apparent economic growth at the time, but then people realized that a lot of that was malinvestment and whatnot. But then, in response to the 2008 housing crisis and recession, there was a lot of stimulus and there was monetary policy, monetary policy. And they lowered interest rates a lot. And the interest rates even went I think to zero or near zero. They never went negative in the US, but abroad, there were definitely a lot of countries that were negative and maybe still are negative. I'm not sure if anywhere is negative at this time, but probably somewhere. Anyway, so interest rates, that is very rare historically, is that low of interest rates. Interest rates have normally been much higher. And so what he was saying is that if we had, let's say we got everything perfect, then we would expect that interest rates would normalize. We could then have interest rates at a normal level. And if we did that, this would cause corporate insolvency because they can't refinance more.
To where they were in the 70s. Corporate borrowing rates go back to where they were in the 70s. There would be an extreme scenario that some people are predicting. The entirety of corporate profits would be wiped out.
Going to debt service.
Going to debt service. That's right.
And you're actually, to be more dramatic about this, right? You're actually referring to the debt service associated primarily with the interest expense.
Yes.
We're not talking about the cash flow characteristics of your inability to refinance at the higher interest rates because of the deterioration in corporate credit quality that would imply, right?
Yep.
The lower servicing of EBITDA to interest payments, for example.
It's as dramatic as this is, it's actually kind of a best case scenario because it doesn't assume an increase in defaults. Right. Because people are unable to roll their debt. It just assumes they have to pay more to service the debt.
And the increase in part, unfortunately, what that creates is conditions under which we understand that the collateral that credit represents in the system, whether we think about it in the IG space or we think about it in the high yield space, that is somebody's asset, right? And what you're describing are the conditions under which that asset falls in value going forward, which reduces the borrowing capacity of the overall system as well. This is my primary concern with the way that we have set up the system. I forget who it was actually highlighting this, and I thought it was actually a really, really good observation that the system has moved from one that is predicated on the idea of fractional reserve banking, where the banks are the source of leverage. And increasingly, we've moved to the shadow bank system where repo and collateral sit at the core of the lending situation, right? The ability to lever a portfolio by posting collateral is kind of the core of what allows us to expand or contract our credit at this point. And as we move from a low interest rate environment to a high interest rate environment, by definition, we actually are contracting that collateral. As a bond matures towards par or a bond matures toward risk of default on the inability to refinance, the collateral in the system falls and the Fed is forced to intervene yet again.
Yeah, because then you run and rates go up 100 basis points, all to explain that concept. So it is on the flip side of it, what's interesting, despite this extreme corporate debt to GDP, and it truly is extreme by any measure of history, and it's also replicated by the fact that borrowing levels to GDP are at the highest level that they've ever been. U.S. Treasury borrowing levels to GDP, the deficit's at the highest level it's ever been, except for World War II. That's the other aspect. It's not just corporate borrowing, but oddly, right now, the corporate bond market is so complacent because they've kept rates down low, they backstopped it, and the problem that's introduced. If they're successful on the other leg of it in simply capping rates, they're able to successfully cap rates. polish. I might polish
I love
it.
this. I love this. This is very interesting. I think a lot of stuff he said is interesting. Actually, I want to research some of this before next time and dive a little bit more deeper, just being a little bit more informed. You might be able to tell this isn't necessarily my area of forte. I just, I enjoyed this topic. I think that this is a very cool. I just love these guys. They're very smart, and there's a lot to learn here. So I'm a student of this, just like you listening to this, or maybe you know more than me. In which, thank you for giving me the opportunity to talk about this in an area that you know you're going to make about the pension solvency crisis, probably under that scenario. Like, there could be some problems there, but they'll probably be able to make those payments. So corporate actually can really harm retirement savings because, Treasuries are basically not yielding any returns. And this can just really cause a lot of issues. I want him to explain the exact dynamics of what he's thinking, but you can imagine how a lot of pensions are dependent on this, they're dependent on treasuries and debt as part of their portfolio. And if you make the returns of that asset class very low, in the long term, they're not going to necessarily be able to pay out their obligations. So there's interesting dynamics there. I want to hear about this next time. I think this is a great place to stop. It's halfway through. And tomorrow we will finish reviewing this. I'll come with a little bit more receipts and research, and we're going to continue learning about volatility. And I think after that, we'll probably need to do a bit more, since this was a very topical, it was very much, they're talking about current events here. And this was back around the time of COVID. So this is not actually a very theoretical interview. We're probably going to have to go through volatility, but I think this is an interesting introduction because it talks about a lot of tangible real world events. So anyway, thank you for tuning in. Remember, if you're watching right now, please subscribe. I do content like this every day, every weekday. I guess I won't be on tomorrow because that's Saturday, but Monday I'll be back. And thank you. Please like this video if you're watching.